Hello guys, good morning. Here is a question of one of my subscriber asking, what is the difference between investing and trading? Okay, so there are big differences between investing and trading, and you should understand clearly the difference in order to do what you want to do. Now, investing, it means when you want to buy something and you know what you are buying for a long time. A long time, it means when you invest for more than 1 year. Okay? More than 1 year. 2 years, 5 years, 20 years, 30 years. Like Warren Buffett, for example. He bought some companies like Geico, like Coca-Cola. He bought part of these companies, and because he knew that these companies could have a good future because they have a unique product, because they do something that the other can't do or they don't want to do. So each company has its own specifics. For example, if you see Apple, for example, it makes iPhone, and it makes other kind of thing, iPad and something. This is unique. It means this company is making unique things, although it has competitors like Samsung in South Korea. But the thing is that each company that you want to invest in should have something special. Okay, you don't just go and buy anything that you don't know. Now, second thing is that investing, so the first thing we say, time. You should need time. It's not, you don't invest for 1 day. That's why what you see in TV news, and they try to mislead people, although the TV, you trust the TV. It means when you watch these Wall Street guys, analytics, those people who do the show, TV show, playing with people money, okay? So they try to mislead the people in a way that it says, oh, the investors think that the stock market will have a problem, so that's why today we have a drop in the price. This is stupid. An investor doesn't do a decision in 1 day. Okay? He doesn't see the news in order to take a decision, very quick decision. Suppose that someone has put $50 million in a company. He cannot just buy today and tomorrow. Even by buying, he needs time to buy. He needs weeks and months to buy. He can't buy in 1 day. Okay? Because it's too much. Because you will see that the price will go up so high in 1 day. That's why he should not show his hand. So he needs professional to buy for him little by little. Not to show his hand, because a lot of people, day traders, they will make too much money when they see a spike like this. They will buy as much as they can and they make a profit, and they will sell later, so the price will go down later. So the first thing, as I tell, you need time. More than 1 year, okay? 2 years, 3 years, 5 years, 10, 20, 30. So some people, they invest all their life. When they are in the 20s, 30s, if you put just $50, $20, $100 per month, you know, 20 years, 30 years, 50 years, just by the time, you will be a millionaire just by time. No, even if you are putting little money. That's why, because you have time. When you are young, like you are 18, 20, 25, 30, you have time until retirement. So if you just put little money, I'm not asking people to put 20% of their money or 30 or 50%, or no, it's too much. So, but some people, they do because they have too much money, but regular people, they don't have that much money. So you have to invest even little money, even if you don't have. Investing is very, very important in your life, because when at whatever time, if you have a broker account and you invest just in some companies and you don't sell, okay, people who buy for a long time, they don't sell very quick. It's not because the stock has gone $1 or $2, you will sell all what you have and then you buy it again. So here you are not doing investing, you are doing trading. Okay, this is the difference. Now, this is the first thing we say, time. Now, second thing, you should know the company that you are investing in. You cannot just go online and some analytics or some journalist or some TV show or a chat room and they say, oh, okay, this company is good, buy it. No, you should never do that. You should do your homework. If you are interested in some companies, go to them, search the financials, search the history. If you know the company by itself, for example, here in America, a lot of companies are very known. They have stores. So you go to the stores and you check, are they doing good business? Check the financials, check the management. It means you should do your homework. And then when you decide, you should find an entry to buy. You don't buy at any time. You should wait 1 year, 6 months, depending on the entry that you want to. And then you buy your shares. And then, if the stock, this is what I am telling you, if the stock is going up, you add up. This is investing. If the stock goes down, stop. Why is that? Because sometimes some companies, they have problems. When you buy the company shares, it was good. The stock was going up, but then because of competition, because of problems, the stock will go down. And then if you add up, you are adding up for a loser. Okay, a company was $100, for example, and it's very well known, and you want to invest in it. So this company from $100 next year it is $120. So you are getting money. It's very good. But the second year from 120 it goes to 90. And you say, okay, 90 is a good discount, so I buy. But who tells you that 90 couldn't be 70, 50, or 40? Who? Stop listening to people who the only thing they want from you is you spend your money on a loser. Okay? This is my advice. Always buy something that it is going up, because you are going long. It means you are buying to have a capital gain. What is a capital gain? It means the price is going up and up and up. So you are making money with the company. The company is making money, you are making money. Now, if the company is losing money, you will lose money too. So we are not here to lose money. We are here to make money. If I lose certain amount of money, I exit the company. I search for another company that it is better. Okay? It's not only you don't only have one company. You have thousands of companies to choose from. So why you worry about one company? And don't love a company. For example, you love Apple. Apple is trading like 600, or Google is trading 1,000 something. Okay, you love this, but you don't know. From 1,000, it could go to 500 next year. Maybe the search engine has a problem. Maybe something else. Okay, so this is the second thing. You should know what you are doing. Don't buy without knowing the company. You don't know if the company is making money. You don't know the competition. If she has a very harsh competition in its niche or in its industry. And you should see a lot of things in order to invest. Okay? If it is your company, it means you are working, you are an employee, and you are working for the company, and you know your company is very well. It's making a lot of money. You have a lot of bonuses. your company is doing so great, and it is a small company. So the good thing is, okay, and the company was $10. Next year is $20. Okay, this is a big opportunity to buy from your company, because most of the companies, they sell their shares to their employees through the DRIP program. It means you buy little bit each time, and they let you buy without commission, which is very good, without going outside and having a broker. Now the third thing I will tell you, don't put all your eggs in one basket. Okay, this is very, very important. This is what we call diversification or something, but take it as simple as this. Okay, you want to buy, don't buy one company, because if one time the company goes wrong, you begin to lose all your money that you put into years. Okay, so this is not good for you. Okay, this is the third thing. So we say time. You need time, more than 1 year. You need to know your company, okay, about competition, about the thing, and you shouldn't put all your money into one company. It's preferable to have 2, 3, 4, 5 companies, and you invest the whole year, the whole years. Most of the time, try to check for companies that are not very expensive. Okay, not less than $5. From $5 on on. Okay, $7, $10, $15, $20, $30. These companies, when they go wild, you can have too much money. And I have given you an example. One of the examples that I always give in my videos is PCYC, which is a pharmaceutical company. From $6 in 1 year and a half, it goes to $135. Okay, these companies that you are searching for, companies that are small, but they become bigger and bigger because mutual funds, big traders, and large institutions buy the shares. When they buy the shares becomes bigger and bigger and bigger, and all the people, when they know that something is moving upward, all they go and buy the company. That's why a lot of people, they make millions of dollars because of this, because of company that it is successful in terms of investing. It means a lot of people, they invest in it. It means they buy the shares. Okay, so your life is linked to this company life. Okay, now we spoke about all these three things, and there are some people, when they want to buy, they buy at a discount, not when the company by itself is going down. You should never buy a company when it's going down by itself. You see that one company is going down and down and down, don't buy it. You should see the sector and industry that it was in. If the industry is going up, you buy. If the industry is going down, you should see if it stops and go up again. I have made a video or 2 videos before about the Dow. When the Dow goes down and it stops and then it go up. I did a video in 2012. At that time, I think the index was 12,000. Now it is 16,000. You see, in just 1 year or 2 years, all the companies that are in the Dow and industries, they go so high. Okay, how do I know this? It's just by looking at the history. Okay, when the whole industry go down, don't buy. When it begins to go to stops, the price stops going down and it goes up, at that time you buy. Okay, this is the time. There are some technical analysis that I use in my book, I use in my strategy, that gives you a signal. Now this signal is 99 0.99 true if the price goes up again, again, again. But if it goes to the support line, it goes down, there is no need to stay in this company, or it's over. Okay? Now, for the stop loss for investing. Now, you will see that when you invest, it's a long time. Okay, you are not investing for you are not trading in one day, 1 week, 5 weeks, 6 or 7 weeks. So your stop loss should be down. Some people, they use until 50% of your money. It means leave the stock to live, because in the stock we have ups and downs. Okay, ups and downs, meaning that sometimes just people, they short the stock. It means the company has nothing to do with the thing. The company is still strong, and then after they short it for 1 week or two, and then the people, they buy again thinking that it is a discount, and it goes up again good. But if a company is losing money, and you know that, because you should follow these companies. It is not like trading. Okay, investing, it means, as I told you before, don't buy too many companies. Like you buy 20 or 30 or 40. You buy 100 share here, 10 share here. It's a waste of time. Don't buy too many companies. Buy the thing that you can follow. For example, if you buy like 3 or 4 or 5, depending on your money, you can follow the earnings of the company. It's 3 months. You see these companies. Are they going up or going down? Are they making money? Because if the company is making money, it attracts other investors and mutual funds to buy it. But if this company is losing money, the investors will escape this company and they sell their shares. That's why when we see a company that it is losing money, you will see that there is a downtrend, a very, very long trend, 1 year, 2 years, 3 years. You see it from 45, it goes to $10 or $5. Okay? So, and some advisors, I see them online, and believe me, don't average down the stock. Some people did tell you, oh, okay, if the stock goes down, buy more. Okay? This is a false statement and a false advice that can ruin your life. If stock was 45 and then it goes to 30, why should I buy a stock that it is losing money? I buy more, it means I will sink more. And from 30, in 1 year it goes to 20. So I lose, I will be the stupidest person on earth to buy something that is losing money. Because you are buying the stock to go up, not to go down. You are not shorting. If you are shorting the stock and it goes down, you are making money. It's very good for you. But you are investing and looking for the future, that the shares have capital gain. It means going up. Think logically and use your brain. Okay? Don't use your feelings. Don't use your emotions. Oh, okay, I like Google. I buy Google. But Google is 1,000. And suppose that after 1 week or 2 weeks, it goes to 800. Will you buy more? And from 800 it goes to 500, like in 1 year. Do you buy more? It means it's losing money. Don't trust any company in the world. Don't trust anyone. The only thing that you trust is what you see on the tape. It means the price. The price is going down for a company. It means there are short sellers. Also, big people are selling. If these big people are selling, it will ruin the company. It means if the big guys are selling, how can you wait? Because they can't sell in 1 day or 2. They need time to sell. So for you, if you see a signal that the company is not doing well and the price is going down, just get out from it and wait. Because if it goes down and then it can go up, you can buy it again cheaper and you can buy more. Okay? This is a good strategy. Why I should buy? Why I should buy when it's going down, averaging down, and it go down, I buy more. It means I am sinking more. I am losing more and more and more money. Okay? This is basically, in general, investing. Some people, I see gold, silver. Don't be like stupid like some other people who are online. Gold and silver and the other material, precious material, they have gone wide from 2009 to 2011. This is the time that you should buy, but you didn't buy at that time. Now when the price is going down, they ask you to buy because the people are selling. They don't care about gold and silver as precious metal, because it's the value. Okay? It's the value that it is very important, the value of money. If I have 1 ounce of money, of gold, with, it was 1800. Now it's, I think, I don't follow gold, but I think it's 1300. Okay? So you lost a lot of money if you buy at 1800. Now it's 1300. You lose a lot of money from this gold. And they say, oh, okay, keep this physical gold. It's good for you. What? It's good for me? Why should I keep something that it is losing money? Okay? I can't hold on a loser. Okay? Anything, gold, precious metals, any company whatsoever, it's the value of the share that tells me what to do. It is not the precious metals, physical precious metals or anything else. It's the value of the share of the thing that makes me decide to buy or to sell. Okay? Now this is all about investing. Now we go to trading. Trading, it's totally different from investing. In trading, you don't have to know the company at all. Okay? For me, sometimes I buy some companies, I buy some shares. Believe me, I don't know what they are or what they are doing. Okay? They are going up. I buy them. I make some money. I sell them. That's it. Why should I see the company? What is this company? I don't care. Because I am trading, I am not investing. I'm not seeing the financial of this company. Because for me, I don't care about the fundamentals. I see the price. If the company, they say it's bad and it's worthless, it was $10 and it's going up to $100, okay? I am buying this company. Whatever the people say, whatever the media say, whatever is the person who is very, very famous, wherever he is famous, in TV or in chat rooms or in wherever a place you want, okay? Even if he is the best investor of the world, they say, okay, don't buy this. Okay, I will buy it if the stock is going up. Okay, understand that. Now, trading, we have three main things about trading. 3 types of traders first. We have what we call a day trader. He trades only in one day and he sells in the same day. He doesn't let his money to stay in a position. He tried to liquidate his position. Now, why is that? Day traders are very famous not to let their position stay overnight. It means if they buy today in the morning or in the afternoon or something, they will sell because they want just a profit in the day. At 4 o'clock, they close the position and they go sleep, okay? Because they have worked too much in the day, or they have fun, or they stop doing business after that. yeah, they can search for the news, they can search for all other stuff, but their day is finished, so their money is in their broker account. Okay, so he doesn't let any money into opposition to the next day, like what we call swing trader. Now, for example, for me, I'm a swing trader. It means if I buy today, I will not sell today. I will say tomorrow or after. 1 week, 2 weeks, 3 weeks, 1 month, 6 months, depending on the stock. If it goes up, I stay. If it doesn't go up, go down, I will sell. Now, this is about day trading. Because of what we call the night shock. Sometimes, when you buy a stock today, tomorrow we have bad news after the trading hours, and you see that your stock go down into a gap down, and you lose a lot of money. For example, you buy the stock at $20, and the next morning it's $15. That's why there is a big risk when you stay at night. That's why the day traders, they don't want this risk. They want to check what they buy and to stay with their position, and they sell it. They have some money. That's it. That's what they want. They want money that it is quick. Either few minutes position, or half an hour, 2 hours, 3 hours, 4 hours, or the whole day. But their ideal thing is that they go quick. They enter the trade quick when they see an opportunity of the stock going up or down, and they quit and they exit the trade very quick. And they are very, very disciplined. These guys are for the money, okay? And they don't play with the. If they begin to lose, there is a stop loss, and they exit and they choose another stock or another thing. They are not playing. That's why they are highly professional, those who do day trading. It's not easy to do day trading because it needs a lot of effort, it needs a lot of work before and after in order to make day trading. And you should have a large capital, more than $25,000, which is not a big capital, but it's like the minimum, because if you are $25,000 and less, they will not let you day trade, because the broker will block your account because of the day trader pattern. It means if you are doing more than three trades in a week, day trades 3 weeks, they will stop you, and they flag your account as a day trader, and they will not let you day trade. So what you should do, you should have more than 25,000, 26, 27, 30, 35, depending on how much money you have. Okay, this is a day trader. Now, swing trader is a person who buys today and he sells tomorrow or afterwards. Okay, swing traders, they look for a short-term uptrend or downtrend. Okay, it means from 2 days, 3 days, 1 week, 2 weeks, depending on the stock. Okay, so, and for the other day trader, trader who is called position trader, is looking for a long trend. Okay, so his stop loss should be lower than swing trader. Okay, so stop loss for a day trader is it counts for cents. For example, he buys like 20, 50 cents. Okay, if he wants to exit the trade like 20, 45 cents, he will exit, because because if he stays more, he will lose a lot of money. Okay, if he is going up. Now, a swing trader, he can use 50 cents, $1, $2, $3, depending on the situation, depending on the volatility of the stock. Now, the other guy who is position trader, he put his stop loss lower, like $2, $3, $5, depending on what he is looking for. It means he should leave the stock to breathe. It means to go down and up and down, and he is making without going out from the stock, because he knew that this stock is going up for sure. So he will stay in order to make that much money. Okay? Now, and that's it. Trading is not investing. When you are trading, you have a short time compared to investing. And there is another thing about tax. When you are not investing, not from 1 year and less, if you hold the stock for less than 1 year, your tax will be higher than if you are an investor. So the SEC, it means the Security Exchange Commission, and the IRS for taxes, they tax more people who are traders, position traders, swing traders, and day traders, as if this is an income, as if you are working like when you work in paycheck or salary, you are having an income, so they charge you more tax than if you are an investor. That's why investing for the long run and without selling is a good thing, because you don't pay as the others do. This is because the American government here, or USA or Europe or wherever, they want people to put more money on the companies in order that those companies become bigger and bigger. And who is the winner? It's always the government, because they have tax from companies, and that's why they become rich or they become poor. Okay, so excuse me. So this is in general the difference between investing and trading. The most apparent thing is time and tax. If you want to invest, you should think more than 1 year, and you should know the company you are doing, and you should buy at a discount. You shouldn't just go and buy a company. You should go buy a discount. I explain this. And if you are losing a lot of money from a company, just exit and find another company. Don't stay too much in order to lose all your company about this. Okay? And if you are quick, like a day trader or a swing trader, a position trader, you don't have time. You don't like to stay too long. You are following trends, and this is a big difference. In investing, you are not following trends. You are following company stock, company competition, company thing. You are part of the company, and you are and you can see. Try, for example, to see in the 50s, in the 60s, 70s, 80s, people who bought the stocks at that time, now they are millionaires. Even if you put $20, $30, $50 in those companies. Okay? Those companies, because they become bigger and bigger by time. Okay? But if a company is losing money year by year, this is a very dangerous thing to stay. That's why the good thing is you should exit this company and find better company. Okay? And as I told you before, try to find companies that are above 5, like 7, 10, 15, 20. Because these companies, this is my advice, these companies, when mutual funds buy them, they go very, very quick. 300%, 500, 600% a year. And this is how the rich become richer. It means they find these small companies, and they see that mutual funds are buying because the stock is going up. They buy too much, and in 1 year or two, they can make big money. It's like Warren Buffett, what he does always. He is searching for companies that are small, okay? And he injects too much money because he has too much money. So he injects. Now, the companies that is $10, $20, $30, it's going so high because he buys it in many months. He doesn't buy in 1 day. He buys in many, because he buys millions of shares from the company. He buys a big percentage, like 10%, 15%, 20% of the company. It means he can own the company if he wants. But Warren Buffett, it's not his aim to own companies. Some of his old companies that he owned, that's enough. But he's like an investor in the mind of trader. Okay, he buys for 1 year, 2 years, 3 years. When the stock goes too fat and too big, and he has a large profit, 300%, 500%, he will begin to sell all his stuff, and then after he sold, you see a big spike down. Okay, many days. And then when he buys all his shares and he get too much profit, what did he say? He go to the media and say, oh, okay, yeah, I bought this company, Chinese company, 3 years ago, $20. I sold it $200. When I see the stock doesn't go up or the company has nothing to offer, what is this? He's trading. He's not investing. It's just he needs time that the people have advertisement on the company to buy more and more and more. And you know, there are a lot of people, when they see a company is going up, they buy. And if they heard in the news that Warren Buffett or big trader they have bought it, they just go blindly and they buy. Okay? Now, when they sell after the news, they say, oh, okay, I sold my shares for this company. It doesn't go that much up, so I bought it with 20, just 20, and it is now 200. Okay? And he sold and it's over. And then Warren Buffett or anyone else, he will choose other company with 10 or 20, and he will do the same. And this game he has done all his life. Okay? And people, they don't understand that these people, Warren Buffett or anyone else, they are for money, for your money. When all the people put money in that stock, he will sell and he will get all the money of the people. That's why he become so wealthy. Okay? It's not he becomes healthy because he knows that the company will go up. No one knows if the company is going up or down. But because he has money, he can make any company go up. Any. Because he has too much money. Okay? And he's not, I don't think he's working alone. He has a bunch of professionals working for him. Because he can do something by himself. You know, a lot of things should have professionals to do that. Okay? So, as I told you, investing is, if you are right in the company, you will be superior than any trader in the world. Why? Because you will stay with the company 10 years, 20, 30, 50 years. And the company that are $5, $7, $10, in 20 years, 30 years, maybe it becomes $200, $300, $500. I don't know where it goes. And thus, you become a rich man. Okay? Because of the time. Time is very, very important. Okay? And since you are young, if you are 18, 20, 25, try to invest in some companies and just leave the money and invest more and more if the company is getting better and better. If the company is losing money, stop. Don't add any money when the company is losing money. And there is a limit. If you think that the company is not doing anything and you are losing money, you should just exit the company and find another one. Okay? So, excuse me. So, thank you very much for watching. If you have any question about investing and trading, please just ask questions. It's a very, very big subject. It's not easy to do investing and trading, the difference in short little time, because there are a lot of things. I have said a lot of things, but there are other things that are very important in investing and trading. And that's it for today. Thank you very much and have a nice day. Thank you.